Okay, we're going to do an installment note, and it's January 1. Pasta Disasta buys a vehicle in exchange for a $10,000 note. The note requires 3 installment payments. The amount of the installment payments is $3,672. Now, I will tell you that this amount is actually determined so that by the time you make 3 of these payments, the car dealer will have received $10,000, the equivalent of $10,000 plus 5% for those 3 years. So how does it get recorded? Well, let's first do the what you're getting. You're going to get your equipment or vehicle, $10,000. So we're going to debit equipment, and then we're going to credit notes payable for $10,000. And at this point, there is no interest because they just got the car, just borrowed the money. All right, now let's say it's a year gone by. It's December 31, and we'll say that's when the first payment is due. So what's going to happen is they're going to get out their checkbook. They are required to write a check for $3,672. So you're going to reduce your cash by $3,672. Then what that is paying is part of its interest, and the amount of the interest is going to be the PRT. The P is your notes payable balance, and we'll see that this changes over time because we're going to, I'll show you here in a second. But your $10,000 is your principal times the 5% per year, and they've had it for a full year, so it's times 1. So that amount equals $500. Now you can see that we don't have an entry that balance. Well, that's because these installment payments not only cover interest, but they also help bring down this note payable balance. So the amount that is helping to reduce your liability here is $3,000, the payment, minus the $500, which will give you $3,172. So now, when you post these, you're going to have your cash going down, credit cash. You're going to have your interest expense. That's the second step. And then the difference, to balance your entry out, is a debit to notes payable. So now you can see our balance, or how much of somebody else's money they have use of for the next year, is now lowered to $6,828. So now let's go to the second payment. We have, again, your cash is going to go out. It's always the same amount, the $3,672. That's a commitment. Now, by the way, I'm rounding these numbers to the nearest whole dollar, so you'll be doing that in your assessments as well. So then what you do is figure out what's the interest for using this amount of money for the year. So you're getting a service. When you get a service, that's an expense. The P in this case is $6,828. The rate is, again, 5% per year. It's been an entire year. So the amount of interest for the second year is a little less, and that's because you didn't have as much of somebody else's money that's being charged 5%. So the difference, you can see our entry doesn't balance. It goes to that notes payable. So the difference to make us balance, if you take that difference, you get $3,331. Posting that, credit goes to, oh sorry, I meant to tell you this, of course, the past years, or the ending balance of the prior year becomes the beginning balance of the new year. We have the credit to cash, the debit to the expense, and the difference to make you balance is a debit or a reduction to the liability notes payable. And the balance now will be $3,497. Now we're at the third and final payment. You're going to again credit cash for the same amount, calculate your interest, and now you'll see the interest is going to be less because the principal is less. That interest comes out to be $175. That difference is a reduction to your notes payable. So now let's see how that looks on the T accounts. We're going to carry, oh sorry, that's $3,497. You're going to carry forward the ending balance from the prior period, $3,497, and you're going to credit cash, $3,672, debit your expense for $167, the difference, notes payable, and as you can see now, you've paid off the note. So if you add up these payments of $3,672, you can see it's more than $10,000. That additional amount over $10,000 represents this interest expense that gets recorded every accounting period. Take note that the expense gets less every payment because every payment, a portion of it helps to reduce the liability, making the liability smaller, making your interest smaller. So that's how installment notes work.